India's P2P lending industry has come to a halt and it may have to stop customer withdrawals in this week. How did all of this come to pass? So, first, what is P2P lending? Now, traditionally, banks perform the job of lending money, giving out loans, and they also take deposits. Peer to peer lending or P2P lending is an idea where you and I, common people, can lend our money to other ordinary people. And in between, there is a platform called a P2P NBFC, an entity that is regulated by RBI. Now, this industry has grown massively in the past 4 years, and today is approximately 10,000 crores of size, and they have about 10 to 15 lakh lenders or investors on the platforms. And RBI has allowed this industry to grow under its watch. Now, unfortunately for you and I, this growth was propelled by a certain creative interpretation of RBI regulations. So, what were these creative interpretations? The first creative interpretation was that if you wanted to withdraw your money immediately, called instant liquidity, then the P2P NBFC would simply transfer your loans to somebody else and thereby give you an exit. They call this a secondary market. This is not what the RBI had intended. They had intended that investors take the risk of the borrower not paying back and they get their money on the maturity of the loan, not that loans be shuffled around from one lender to another. The second creative interpretation was about absorbing losses. Now, generally, P2P platforms give out loans at interest rates of 18 to 20%, and they give investors returns of 8 to 10%. So this spread of approximately 10-12% is pocketed by the P2P platforms, and it's also used to absorb all of the defaults. This is why in the past few years, hardly any investor in P2P platforms has seen any default. And this allowed P2P platforms to tie up with India's largest fintechs, namely Borate and Cred, to launch platforms like the Bharat 12% Club or the Cred 9% Club, where investors were given returns up to 12% or 9%. By the way, these tie-ups where the P2P platform facilitates loans given by users of fintechs like Bharat to other users of the same fintech, again like Bharat or Cred, they're called closed group lending. This too, RBI has banned. So all of these creative interpretations led to a huge growth in the industry, including mutual fund distributors were selling this idea of investment to their clients, and more retail investors were joining these platforms and creating, in effect, an unregistered shadow bank. And all of this, by the way, under RBI's watch. So now the central bank has woken up after 4 years of slumber and on Friday released a circular saying that all of these practices are no longer allowed. And to comply with this circular, the industry will have to stop withdrawals, because withdrawals rest on them being able to shuffle around loans to people who don't want to exit and give an exit to people who do want to exit. Either they stop withdrawals or they do not comply with the RBI circular, or RBI gives them a relaxation. Whatever happens, it is India's investors who've been put into jeopardy because of RBI's slumber and because of creative interpretations by this industry.